from earning $750 a year on your savings to earning $2,550 with the same money in a money market fund. These are 7 investments that are keeping you poor. It sounds almost too boring to be powerful. Government-issued bonds that adjust with inflation. But that's exactly what makes Treasury inflation-protected securities, or TIPS, such a quiet financial weapon. Let's talk about the illusion first. Most people keep their savings in a bank account because it feels safe, it's familiar, it's insured, it's liquid. But here's the truth. If inflation is running at 3 to 4% per year, and your savings account gives you 0.5 to 1.5% interest, you're losing money slowly and consistently. Now enter TIPS. These US Treasury bonds aren't just government-backed. The principal increases with the consumer price index, and you earn a fixed interest rate on top of that adjusted amount. So when inflation rises, so do your returns. No tricks, no erosion of buying power. In 2022, for example, TIPS returned over 7% during one of the worst inflation spikes in decades. That's not a fluke, it's the design. Let's take a real case. Sarah, a 52-year-old nurse in Denver, moved $50,000 of her emergency fund into a TIPS ladder. Over 3 years, she earned nearly $5,800 in inflation adjustments alone, while her friend, John, who kept the same amount in a high-yield savings account. Why don't more people do this? Because TIPS don't scream wealth. They don't show off. They're not flashy, but the people who protect their wealth quietly, they usually keep it longer. So what do the financially savvy do? They use TIPS as a foundation, the stable core of a portfolio that won't bleed under pressure, especially for emergency funds or short-term goals. TIPS beat the pants off letting your cash rot in a regular bank account. Here's a simple comparison. $100,000 in a savings account over 10 years at 1.5%. Interest with 3% inflation equals a real loss of over $15,000. That same amount in TIPS, assuming average CPI adjustments, would not only preserve value but likely grow modestly, safely and predictably. Comment shield if you didn't realize the government actually sells you something that fights inflation directly. And if you think inflation protection is useful, wait until you see what happens when cash gets split into thousands of tiny, liquid safe pieces that live outside the banking system. They look like savings accounts. They feel like savings accounts, but money market funds aren't tied to your local bank, and that small difference can be a massive financial upgrade. Most people trust banks because of FDIC insurance, and yes, it's important, but the real risk isn't that your bank collapses. It's that your money quietly dies there, while you sleep peacefully with your 1.2% high-yield account. Inflation is charging 3% on everything you buy. That's a 1.8% net loss every single year. Money market funds, on the other hand, are mutual fund vehicles that invest in shorter, high-quality debt like treasury bills and corporate paper. Translation: your money gets spread out across the most stable, liquid instruments available, and it earns more while doing it. In early 2024, some of the most trusted money market funds were yielding over 5%. That's more than triple the national average for savings accounts. And with lower risk thanks to broad diversification and strict regulation under the SEC Rule 2A. Here's a real-world example. Anthony, a freelance designer in Boston, kept $30,000 in his bank for 3 years just in case. He earned about $1,200 total. His sister Sophia moved her same emergency stash into the Vanguard Federal Money Market Fund. She walked away with over $4,000 and had the same instant access when she needed it. So why does the average person miss this? Because banks don't advertise what doesn't make them money. They profit when your money sits there, underperforming. Money market funds, you have to go looking for them, often through your brokerage account or retirement plan. Here's the big takeaway. Money market funds aren't sexy, but they're strategic. They give you cash-level access with bond-level returns and systemic-level safety. You're not just avoiding inflation. You're finally doing something with your liquidity. Now for the math. Put $50,000 in the bank at 1.5% for a year. You earn $750. And speaking of safety cushions, let's talk about something that doesn't just beat inflation. It chases it, locks it down, and rewards you for holding on.
Imagine if the government said, "Hey, inflation is getting bad, want to make money from it." That's not fiction. That's literally how I-bonds work. These are Series I savings bonds issued directly by the US Treasury. They're designed with one mission: protect your money from inflation. While your bank gives you 1 or 2% interest and a pat on the back, I-bonds laugh in the face of inflation and hand you the difference. Here's how they work. I-bonds pay a fixed interest rate, currently 0.9% in 2025, plus an inflation rate that adjusts every 6 months. That means as inflation rises, so do your returns. In 2022, I-bonds paid over 9.6% annually, while savings accounts barely coughed up 1%. They're backed by the US government, meaning virtually no default risk. You can buy up to $10,000 per year per person, plus an extra $5,000 with your tax refund. Hold them for at least 1 year and they become a fortress. Hold them for 5. No penalties, no surprises. Take Raj, a 38-year-old IT manager in Seattle. In 2021, he put $10,000 into I-bonds at 7.12% interest. By the end of 2022, that money had grown to over $10,800, all with zero stock market risk and no fees. Meanwhile, his buddy who left that same cash in a premium savings account made under $200. So what's the catch? You can't sell within the first year, and if you cash out before 5 years, you lose the last 3 months of interest. But when the trade-off is inflation-proofed savings with guaranteed growth, that's a small price to pay, the smart money. It uses I-bonds as a core savings vehicle for medium-term goals like a home down payment, college fund, or emergency buffer. You get protection, predictability, and peace of mind in one move. Here's a fun calculation. If you put $10,000 in an I-bond in 2022 and inflation averaged 8.5%, you'd earn around $850 in 1 year. A bank savings account at 1.2%? Just $120. That's $730 gone, and for what? Convenience? Subscribe if you've ever justified keeping your emergency fund in a savings account just in case. Because guess what? You're still losing money, just more slowly. And if you thought that was a good government-backed inflation play, wait until you see what happens when you buy something shiny that doesn't trust, inflate, or default, and you can store it in your pocket.
It glitters. It's ancient. And for thousands of years, it's been the ultimate symbol of wealth. Gold. But here's the twist. We're not talking about hoarding coins under your mattress. We're talking about gold-backed ETFs, the modern version of a centuries-old hedge against inflation and uncertainty. People are drawn to gold for emotional reasons. It feels tangible, timeless, indestructible. When markets crash and currencies falter, gold tends to survive. But buying physical gold comes with a suitcase of problems. Storage, security, insurance, purity, and liquidity. You can't exactly pay rent with a gold bar. That's where gold-backed ETFs, these funds, like SPDR Gold shares, are backed by real physical gold stored in secure vaults, and they trade like any stock. You get the upside of owning gold without the downsides of carrying it around like a pirate. Let's look at history. From 2000 to 2020, gold returned over 330%. During the 2008 financial crisis, while stocks were tumbling 40%, gold was up nearly 25%. In 2022, with inflation raging and markets rattled, gold ETFs held strong, providing stability when almost everything else was burning. Take Brian, a cautious investor in Florida. He shifted $25,000 of his cash savings into a gold ETF during the early stages of the pandemic. While bank yields evaporated, his ETF held its value and even climbed, protecting his buying power while others watched theirs decline. So why aren't more people using this? Because gold isn't productive, it doesn't pay dividends. It just sits there. But when the goal is to preserve value, sitting still is better than sliding backward. Like cash does when inflation hits, financially savvy investors use gold-backed ETFs as a counterweight in their portfolios. Not to get rich, but to stay rich. They balance volatility, hedge systemic risk, and offer peace of mind in unstable times. Here's the bottom line. If you kept $50,000 in cash from 2010 to 2020, your real value dropped by around $7,000 due to inflation. But if you think gold is the only hidden gem for safe, consistent growth, you haven't met the one. Investment type that offers guaranteed principal and contractual returns in a place no one thinks to look. You've probably never heard of them. And that's the point. These funds sound boring, safe, unremarkable. But what they offer is almost magical. Principal protection, steady returns, and very low volatility. While your savings account creaks along at 1%, stable value funds have quietly been delivering annual returns between 2.5% and 4% even through financial crisis. Let's be clear. This isn't magic. It's math and insurance. Stable value funds invest in a mix of high-grade bonds and then wrap them with insurance contracts to smooth out the returns. This means your money doesn't ride the roller coaster of the bond market. It glides. People overlook them because they're usually only available inside employer-sponsored plans. But the people who know, they use them to park large amounts of capital safely, earning better than cash returns without the drama of stocks or crypto. Here's a story. Denise, a 61-year-old HR manager, shifted $100,000 from her 401 money market option into her planned stable value fund in 2019. Over 4 years, she averaged 3.2% returns annually, earning over $13,000 in total. Her colleague kept the same amount in a safe bond fund and ended up losing money in 2022 when rates spiked. That's the quiet strength of stable value. Consistent, protected, and ignored by most. They shine when everything else is chaotic, and they're immune to the typical panic cycles of the market. The trade-off: limited access. You often can't invest in them outside of retirement accounts, and they may have withdrawal restrictions. But for medium-term savings inside they're elite. Let's break down the numbers. $50,000 in a savings account at 1.2% for 5 years. $53,09 is that same amount in a stable value fund, averaging 3.5% equals $59,432. That's over $6,000 difference, with almost identical risk. But if you think that's impressive, wait until we move from quiet safety to income-producing powerhouses that turn your lazy cash into monthly dividends, all without owning a single property. Real estate sounds like a dream. Passive income, property appreciation, tax benefits. But for most people, it's a logistical nightmare. Down payments, mortgages, maintenance, vacancies, tenants. That's where REITs step in and say, relax, we've got this. REITs, or real estate investment trusts, let you invest in income-producing real estate without ever buying a property. You get exposure to everything from apartment complexes and shopping centers to data centers and hospitals, all managed by professionals, all packed into a single share you can buy on the stock market. Here's the emotional pull. People love real estate because it feels tangible, and rightly so. It's historically one of the best long-term inflation hedges. But the illusion is that you have to own property to benefit from it. You don't. With REITs, you collect rental income in the form of dividends and ride the growth wave of rising property values without unclogging a single toilet. Let's get real. Over the past 20 years, equity REITs have averaged annual returns of 10 to 12%, outpacing both bonds and inflation. Even in down markets, many REITs continue to pay steady dividends thanks to long-term leases and diversified income streams. Case in point, Javier, a 45-year-old software engineer in Arizona, had $40,000 sitting in a bank account for future real estate plans. In 2020, he got impatient and put it into a REIT ETF focused on commercial real estate. 4 years later, his portfolio had grown to over $58,000 and paid him quarterly dividends along the way. No mortgage, no maintenance, no headaches. So what do smart investors do? They use REITs as cash alternatives with muscle, especially when interest rates are low and inflation is high. REITs can generate income and preserve capital. Two things your bank account struggles with daily. Here's the math. $50,000 in a savings account over 5 years at 1.5% equals $53,866. That same amount in a diversified REIT ETF returning 9% annually, $76,948. That's a $23,000 difference. And you didn't even mow lawn. But if you thought passive rental income was the endgame, wait until you see what happens when your money owns everything, every sector, every success story, and grows like wildfire over time. It doesn't sparkle, it doesn't have a lobby or a lockbox, but over time, broad market index funds quietly outperform almost every form of safe saving, including that bank account you've been babysitting for years. This is the asset that lets you own everything. The top companies in the world with a single move, whether it's the S&P 500, the total stock market index, or global equity funds. These investments spread your money across hundreds or even thousands of businesses. That means maximum diversification, minimal fees, and historically superior growth. Now let's talk psychology. People hold on to cash because they're scared. Scared of market crashes. Scared of losing what they worked for. But here's the irony. By holding cash long term, you're guaranteed to lose slowly, silently, and certainly to inflation. Meanwhile, the S&P 500 has returned an average of 10 to 11% annually over the last 50 years. Yes, there are ups and downs, but a long-term trend. Up and to the right, cash doesn't do that. It just sits there, eroding. Let's meet Olivia, a 35-year-old freelance writer from Portland. In 2015, she had $20,000 saved in her bank. She was hesitant to risk it, but after reading up on index funds, she put it into a total stock market ETF. By 2023. Her account had grown to nearly $42,000, more than doubling in 8 years. What do the wealthy do differently? They treat cash like a temporary guest, not a long-term tenant. They deploy it. They let their money work, not wait. And index funds are their go-to for long-term wealth building because they require no guessing, no timing, and no constant oversight. Here's the math you need to remember. Put $100,000 in a savings account at 1.5% for 20 years, and you get $134,000. Put that same $100,000 in an index fund averaging 9% and you get $560,000. That's not growth, that's transformation. This next video will save you thousands, literally.